day from ADK Wealth Advisory Group. My name is Dan Davis. I'm president and co-founder. Wonderful fall day here in St. Louis. Unfortunately, fall started a little bit early this year, starting in mid-August, where old news about China's overbuilt real estate and bad debt associated with that created a plummeting Chinese stock market that flowed all the way throughout all the markets. What we call in the industry is a risk-off bet, where pretty much all financial assets that are in the category of volatile, from high-yield bonds to stocks to real estate, they get sold off by more what you would classify as traders, specifically hedge fund traders. Now, when you take a look at what that really means, Warren Buffett summed it up perfectly when he calls the financial markets Mr. Neurotic. And I think that's what you could kind of say in this particular time frame, is the markets have been neurotic. For those of you who are clients of ADK, you're already aware that when we do our research, we take a look at both fundamental research, which is a Western civilization approach, and an Eastern civilization approach called technical research. And we blend those two together. Fundamental research really looks at things like how's the economy doing, measured by GDP, inflation. What's going on with things like the stock market, PEs, are things overvalued, trading at premiums, or are they at normative, discounted values? Where are they? Where are interest rates at? What's going on with the central bank? That's the cumulative view of fundamental research. The strength of fundamental research is clearly that it's able to really give us an idea, are things properly valued or not? On the negative side, though, the Achilles heel is that when you go to periods like 2000 through 2002 or 2007 and 2008, where clearly you have a crisis that causes the financial markets to collapse, fundamental research has been negatively persuaded, maybe even propaganda influenced in a way that big institutions that sell products don't want investors to come out and go back in a product. So as a result, they've convinced in a way that I think is negative to stay fully invested even when periods that are really in what I'll call collapse. Not to be mistaken for normal volatility. During normal volatility, you do want to stay and ride the course. But again, the Achilles heel of fundamental research is really that it has no good answer for collapse, which is why we then blend in the Eastern research. Eastern research uses support levels, resistance levels, graphs, charts to kind of help you evaluate when you get beyond normal volatility, so you're in crisis collapse. Gives you exit strategies and re-enter strategies. All by themselves, I think both are sufficient, but when you blend them together, I think that's when you really have best practices. Don't want to portray some kind of a day trading image, but rather fundamental research blended with technical research to help avoid periods where the collapse happens and you ride all the way through it. It takes like 3 to 5 years to get back. So when we take a look at fundamental research and we look at technical research and we go to Asia, the overbuilt real estate, which typically in Asian China has accounted for about 25% of the GDP growth that they've experienced. So now they have overbuilt real estate. Their GDP is coming in a lot lower than what it has in the past, and it's going to be lower for quite a while. Even worse, a lot of the debt that has been issued on that real estate is going to be defaulted on. The good news for China is that they have a lot of excess reserves because of all of the exporting that they've done over the last decade. So they'll be able to recapitalize their banks and work through it, but it's going to take a while. We've done very little investing directly in China because candidly we don't like the concept of a communist regime that lies as well as manipulates. So as a result, we've stayed out of China directly, but China, being the second largest economy in the world, has an enormous effect on Asia at large. So fundamentally, you've got things like carry trade, you've got things like loans that have been done in US dollars, you've got China's real estate market that really line up to be very negative for Asia. So as a result, the technical research, when we take a look at combining that, also is very negative. So we've reduced our Asian exposure. We haven't eliminated it, but we've reduced it. When you then go to the developed world, the United States, Europe, for example, it's a different story. because there the fundamental research, while it's not rosy, is more favorable than negative. That being the case, when we then take a look at technical research, the technical research is mixed. So fundamentals slightly favorable, technicals are mixed. Our thought is that what you're going to see is that the US is going to experience, as well as Japan and China, this big sideways market, more like what we saw in like a year 2011. Barring any kind of major shocks to the economy, we think at the end of that period, which we anticipate to be like 2 to 5 months from that August origin date, we expect it to then trend upward. If a big shock were to come to the economy of the US or to Europe, neither are solid enough to be able to handle that. It would change our outlook. So we'll be vigilant in watching that. In addition to all that, we take a look at things like central banks. So if you take a look at Greenspan back when I started in the business over a quarter of a century ago, Greenspan had mastered the art of what later became known as greenspeak. He could talk to the financial markets through the media and say things in such a way of calibrating both sides of it and do it in a way that convinced people that it was going to be okay. So far, Bernanke as well as Yellen, neither of them have really mastered that art. And so when they've come and talked, I think they've done more disruption with some of their communication than they have putting it at ease. But all of that said, so much of the media's attention has been on central bank policy. When is the Fed going to raise rates? LPL has been following Yellen's dashboard of economic data since she said what it was. And when you take a look at that, LPL has for a while thought that that raise would not happen until either fourth quarter of 15 or first quarter of 16. And I'd say recent news has caused it to be more likely into 2016, but so much of that data hasn't happened yet, so it's still yet to be seen. Fourth quarter of 15, first quarter of 16 has been our bet, and it's what we still continue to believe. Now, when we then think about Fed policies in terms of a chess game, chess is played in 3 stages. You've got the beginning stage, you have the mid game, and the end game. So the US, when it stopped with the quantitative easing strategy called asset repurchase, printing money and buying their own bonds, when they discontinued that, they finished the beginning stage. We're now at the beginning of the mid game. Japan started after us, and Europe started after them. Both Japan and Europe are still in that beginning stage. The reason why I go into this is really twofold. First, you would consider, if you were going to grade the policy so far, that it would receive a very positive grade. But yet the whole system and the whole strategy has not played itself out, so we don't really know exactly what that's going to end up being when you go out 10 years and look back. The second reason I go into it is that when interest rates do start to go up, if you take a look at right now, the US 10-year Treasury is at about a little bit more than 2%. Before all the Fed policy, it was around 4%. So how long will it take to get back to there? Will it go up above that? Those are some major questions. Well, if you look across the pond and you say, okay, well, if you're a global investor and with the touch of a mouse, you can put money in German bonds, you can put money in Japanese bonds, US bonds, Italy bonds. What's the competition? Well, as I alluded to, US a little above 2, Germany below 1, Japan below 1. So all of a sudden you have these competing forces that if the Fed raises rates, it makes our bonds even more attractive to global investors, which again causes them to get pushed down a little bit. So in the end, I think the general theme is lower for longer. And what I mean by that is that interest rates are going to take 3 to 5 years to be able to get back to that pre-quantitative easing stage. So lower for longer also would translate into what we see around energy. There's been just a ton of discussion and whatnot around what's going to be the ongoing price of oil. And no one really knows. It's a bit like guessing the weather. But we know that it was trading at somewhere between 85 and say 110 as a normal band. Now it's more in the 40s. and we haven't even seen oil coming on grid yet from Iran. So again, the reality of the oil price is lower for longer. So when you think about what that translates to from an investment perspective, the industry is broken into upstream, midstream, and downstream. Upstream is the companies that literally go find it and get it out of the ground. It's going to be very difficult for many of those companies. The strong will survive, the weak will perish, some will perish due to acquisition by the strong, and others will simply go bankrupt. We have very little money in the upstream because of the volatility of sort of the wildcatting, if you will. But the midstream, the areas where you store it and transport it, say for example MLPs, Master Limited Partnerships, primarily the pipelines that transport natural gas and oil. So far, Mr. Neurotic has just sold off all energy, which makes very little sense when you come to the midstream, because the midstream, the transportation of oil, unless you're using 18-wheelers or you're using rail, the pipelines themselves haven't suffered at all, and our view is they won't. But yet the baby with the bathwater syndrome has happened, where people have sold off everything with energy. Again, our theory around energy is lower for longer, but we do like that midstream aspect of energy. In conclusion, our expectations are that we have elevated risk in Asia, both technicals and fundamentals are negative. However, when you take a look at the developed world, you have a different story. We expect those markets to be really choppy sideways for the next, say, 2 to 4 months. And then when it comes to interest rates and energy, the theme of lower for longer. So I'd like to thank you very much for your time today. If you're a client of ADK Wealth Advisory Group, I want to say thank you for your business, thank you for the relationship. Many of you have already connected with us on Facebook. If you have not, simply go to ADK Wealth Advisory Group and do that. You'll see a lot of information that we send out to that's relative on top of these market updates. If you're more of a LinkedIn person, there's a lot of Dan Davis's, so when you're looking for me, just cross-reference it with the ADK Wealth Advisory Group. If you're not a client and you'd like to learn more about who we are, go to our website at discoverindependence.com. You'll find all you never wanted to know and more. In all seriousness, there's a contact tab. Feel free to send us an email or call us if you'd like to ever meet. Thank you for your time. Thank you for the relationship, your trust, and your business. Thank you.